Welcome to StockTok's deep dive into China Galaxy Securities. This is a major player in China's financial services landscape, operating as a diversified securities and investment firm, serving institutional and retail clients across wealth management, investment banking, and trading. China Galaxy Securities operates in one of the world's largest and most heavily regulated capital markets, where scale, regulatory relationships, and brand trust are existential competitive advantages. The stock has traded between $21.30 and $42 over the trailing 52 weeks, positioning it roughly in the middle of that range. As of May 8th, the stock is trading near $28 per share. Let's work through the fundamentals, scene by scene, starting with a quick business overview. China Galaxy Securities generates revenue principally through brokerage commissions on equities and derivatives trading, investment banking fees from underwriting and advisory services, and asset management fees from managing client portfolios and wealth products. The company's competitive position rests on its scale, its relationships with Chinese institutional clients and high-net-worth individuals, and its regulatory licenses, assets that are difficult for competitors to replicate. The StockTok score across 5 dimensions tells the story. Valuation scores 17 out of 20, suggesting the current price appears reasonable on paper. Financial health scores 9 out of 20, indicating material balance sheet and liquidity concerns. Profitability scores 6 out of 20, reflecting extremely weak margins and negative cash generation despite a reporting profit. Growth scores 10 out of 20, showing mixed revenue trends. Smart money scores 0 out of 20, signaling no institutional interest and no insider activity. Overall StockTok score, 42 out of 100. Caution is warranted. Now, valuation. The question every investor has to answer is, are you paying the right price? China Galaxy Securities trades at a trailing 12-month price-to-earnings multiple of 7.31 times. That is cheap on an absolute basis, well below the broader market average. The forward price-to-earnings multiple, however, stretches to 151.2 times, a dramatic disconnect that reflects either a Wall Street consensus expecting a sharp earnings collapse or, more likely, highly uncertain forward earnings estimates. The PEG ratio, price-to-earnings relative to expected growth, sits at 0.9, suggesting the current valuation is reasonable if the company can deliver its expected earnings growth. EV to EBITDA is not meaningful in this analysis given the company's cost structure. The price-to-sales ratio of 2.91 times sits in the middle range for financial services firms. Our DCF fair value analysis, which discounts expected future free cash flows to present value, shows the stock trading at 0% margin of safety. In other words, neither premium nor discount. Wall Street analyst consensus data is sparse for this name, reflecting limited institutional coverage and research depth. Market sentiment around China Galaxy Securities leans neutral, with insufficient recent news flow to establish a bullish or bearish bias. Taking these signals together, a cheap trailing multiple, forward estimates clouded in uncertainty, and neutral sentiment, the setup suggests a fair value range in our view between $26 and $30 per share. This implies limited upside from current levels, balanced against moderate downside risk. The valuation appears neither compelling nor alarming, but the stretched forward multiple warrants close attention to earnings quality and management guidance. Moving to financial strength, how solid is the foundation? The Piotroski F-score is a 9-point accounting quality checklist that flags firms showing signs of deteriorating balance sheets or manipulated earnings. China Galaxy Securities scores a 5 out of 9, falling below the healthy threshold of 8, signaling material weaknesses in financial position. The Altman Z score, a statistical bankruptcy risk model, registers at 0.00, which indicates acute financial distress. This is a red flag. Let's look at the debt and cash position. The company carries a debt-to-equity ratio of 1.34, meaning it has $1.34 of debt for every dollar of shareholder equity. That is elevated for a financial services firm and constrains financial flexibility. The cash-to-debt ratio is 1.38, suggesting the company has adequate liquid assets to service debt in the near term, but the margin is thin. Interest coverage, the ability to pay interest from operating earnings, is not available in the reported data, which itself is a warning sign that the company may struggle to service its obligations from operations. The current ratio, which measures short-term liquidity by comparing current assets to current liabilities, is reported as 0.00, an impossible figure that indicates either a data reporting error or a severe liquidity crisis. Either interpretation is troubling. In summary, the balance sheet shows material stress. Debt is elevated, liquidity is questionable, and accounting metrics suggest deteriorating financial health. This is the single biggest concern anchoring the caution in our StockTok score. Next up, profitability. Is this business actually making money efficiently? The most important metric is return on invested capital, or return on invested capital. It measures how much profit the company generates for every dollar of capital deployed in the business. China Galaxy Securities' return on invested capital is reported at 0.00%, meaning the company is destroying shareholder capital on a risk-adjusted basis, or the metric is not being calculated properly due to data limitations. Either way, this is a deep red flag. Gross margin is 0%, expected for a financial services firm that doesn't have product-based gross profit. Operating margin is also 0%, meaning the company is not making money from day-to-day operations. Yet the net margin, the profit that flows to shareholders after all costs and taxes, is 44.31%. That disconnect is impossible in sound accounting. The company reports a net profit while showing zero operating profit, which can occur only if non-operating gains, such as investment gains or one-time items, are driving reported earnings rather than core business performance. Free cash flow margin, which measures operating cash generation relative to revenue, is negative 93.88%. This means the company is burning cash operationally even as it reports accounting profits. Return on equity (ROE) sits at 8.77%, below the cost of capital for most equity investors. Return on assets is 1.59%. In plain English, the profitability metrics are broken. The company is not converting its revenue base into sustainable operating cash or returns on shareholder capital. Accounting profits appear to be a mirage created by non-core gains, while the business itself is cash flow negative and destroying invested capital. Onto growth. Is this business expanding and at what rate? Revenue growth over the trailing 3 years stands at 14.5%. That is respectable in absolute terms, but it masks a decelerating trend. Over the past 5 years, revenue growth has slowed to 2.8%, indicating the company faced significant headwinds in the earlier period. Book value growth, the expansion of shareholder equity, is 9.7% over 3 years, which is modest. The dividend yield is 3.93%, suggesting management is returning some capital to shareholders. But this does not offset the underlying capital destruction suggested by negative free cash flow and weak return on invested capital. The growth picture is mixed. The company shows some top-line expansion, but the quality of that growth is questionable given negative operating cash flow and capital destruction. Deceleration from 14% to nearly 3% over the longer horizon signals the business is maturing or facing structural competitive pressure. Management has not provided forward guidance in our data set, so we cannot calibrate expectations for the next 12 months. Without clarity on near-term growth drivers or management commentary on business trends, investors face uncertainty in assessing whether current revenue growth represents a floor or a transition to contraction. Now let's talk smart money, what institutional capital is actually doing with this name. The picture is stark. 0 top-tier investment gurus, as tracked by Dataroma's institutional holdings database, currently hold China Galaxy Securities in their portfolios. That is a 0. No Warren Buffett, no Bill Ackman, no Dodge and Cox. This stock does not appear on the radar screen of institutional asset managers, with strong track records of picking undervalued or high-quality securities. Insider ownership sits at 0%. Management has virtually no skin in the game. The executives and directors running the company own negligible shares themselves. This is a major red flag. When management owns nothing, they have no personal downside risk from poor decision-making and are insulated from shareholder pain. Insider transactions over the trailing 3 months show 0 buys and 0 sells. No insider activity whatsoever. When insiders are silent, neither accumulating shares at what they might perceive as a bargain nor selling to reduce risk, it often signals indifference or uncertainty about the near-term outlook. Put together, 0 guru ownership, 0 insider ownership, and 0 insider transactions paint a picture of institutional and informed investor apathy toward this name. The smart money is not buying. This is not necessarily proof the stock cannot perform, but it does mean that investors choosing to own China Galaxy Securities are doing so without the affirmation of sophisticated, long-term focused capital. That carries meaningful behavioral and reputational risk. And finally, the verdict. Let's bring it all together. On valuation, the stock appears fairly priced at current levels, with a trailing multiple that is cheap but offset by a forward multiple that is highly stretched, warranting a fair value range of $26 to $30 per share. On financial strength, the balance sheet shows material distress, with elevated debt, questionable liquidity, and a Z-score suggesting acute financial risk. On profitability, the company reports an accounting profit while destroying capital and generating negative free cash flow, a major disconnect that suggests accounting earnings are not sustainable or backed by real cash generation. On growth, revenue has expanded at a respectable 14.5% over 3 years, but this has decelerated sharply and must be viewed against the profitability headwinds. On smart money, 0 institutional investment, 0 insider ownership, and 0 insider transactions signal that sophisticated capital is simply not interested in this name. In our view, a fair value range for China Galaxy Securities sits between $26 and $30 per share, representing minimal upside and moderate downside from current trading levels. The latest earnings results, which are not detailed in our current data set, would be critical to understanding whether the profitability disconnect is temporary or structural. Overall, the thesis here is cautious. The company operates in a large, accessible market with meaningful scale, but the combination of balance sheet stress, profitability questions, and absolute lack of smart money interest creates a risk-reward profile that does not appear compelling at current valuations. This is our interpretation of publicly available data and is not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on China Galaxy Securities. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.